You know, when I started in the finance industry back in 2000, 2001, one of the ways that I became a bit of a household name that appeared on Bloomberg and CNBC and even CNN very frequently was because I had invented this forecasting method. This forecasting method was the one that allowed me to forecast the low of the bear market in 10th of October 2002, and I had predicted it to be either the 9th or the 10th or the 11th of October. And then I forecasted that there would be a high in the Dow Jones index in February 2004, all of which came to fruition. And so I became somewhat known for the person who was able to predict when the markets would turn, would make major turns, up or down. And when I left to pursue a career as a day trader myself, I think that legacy was still with me, but I found that having a bias, such as I think the market is about to make a top, or I think the market is about to make a low, is actually quite a dangerous trait to possess as a trader. There's a famous saying amongst people who use cycle analysis, and that saying is that that 90% of the move comes in the last 10% of the cycle. And what that means is, and if you can imagine like a bell curve and you have the fat tails, the vast majority of the moves always come just about before the cycle is about to turn. So if you look at the crash in 2002, or even the crash in 2009, you'll see that the real big damage is done in that month before the cycle actually turns and turns back up again, because that's where the emotions have been replaced by fear, and people are now just scared and just want to get out at any price, and fear is a really powerful motivator to do things that are ill-considered. But I regress a little bit, because my argument here is that as a day trader, I think it's really important to come in to every single trading day with an almost blank canvas, to the point where you're saying anything can happen. And the famous Mark Douglas, he argued the very same thing, is like anything can and probably truly will happen on any given point in time during the trading day. And I did a piece of research on the Dow Jones index where I looked at the closing prices over the last 30 years in the Dow Jones, which amounts to 7,500 observations. And what I loved about that piece of research, that when I started the research, was the Dow was trading around 3,000, and today it's trading around 43,000. But even though that the market over a 30-year period has moved from 3,000 to 43,000, the amount of days where the Dow Jones closed up on the day and the amount of days that the Dow Jones closed down on the day was 50-50, like literally 49.6 to 50.4. So as a day trader, we might get swept into the psychosis of, follow the trend and the trend is your friend. But in reality, when an index displays that kind of price action characteristics over a 30-year period, it's very hard to be bought in on the idea that the trend is your friend, because over a long period of time, yes, the trend has been up, but in any given trading day, the odds of it being a down day or the odds of being an up day, that's 50-50. So that's why I don't use forecasting in my trading anymore. Rather, I will anticipate in terms of, say, a double top. That's anticipation, and you're selling short a double top or you're buying a double bottom. Or you are reacting, that could be any given number of things like mechanical strategies or whatever it may be. But those forecasting days where I go in and I say things like, I think the market is going to go up today, or I think the market is going to go down today, I don't do that at all anymore.